Well, we're staying with the markets, but this time in the U.S., where stock futures pointed to a lower open today as traders become increasingly worried about political turmoil involving the U.S. President Donald Trump. Investors searching for safety rushed to the yen, sending the dollar to a 6-month low. On the data front, the Federal Reserve Bank of New York releases its household debt and credit report for the first quarter today. On the earnings front, Target posted better than expected quarterly results, sending the retailer's stock 6% higher. But talking about the numbers now, the Dow is seeing 0.42% down, while the S&P 500 and the Nasdaq are also pointing lower by 0.41% and 0.32% each. And Asian markets were mostly lower today, with Dow futures tumbling and the safe haven yen climbing amid political and legal turmoil surrounding President Donald Trump. The Nikkei fell 0.53% to end at 19,814.88. Hong Kong's Hang Seng Index edged down 0.19%. And on the main line, the Shanghai Composite ended down 0.26% at 3,104.74, while the Shenzhen Composite edged up 0.13%. In South Korea, the Kospi ended down 0.15% at 2,291.53. And Australia's ESX 200 dropped 1.1% to end at 5,786. The Frontier Strategy Group believes a lot of executives in the Middle East and Africa are yet to realize that the low growth currently experienced in the region is here to stay for the next few years. Well, that's because consumers, businesses and governments in the region are becoming more price sensitive and cautious. The information and advisory services firm for emerging market executives has been discussing the macroeconomic outlook for both the Middle East and Africa and how they need to adjust their strategies to the new normal of low growth. Well, the Director for Sub-Saharan Africa Research at the Frontier Strategy Group, Anna Rosenberg, joins me now from the United Kingdom to talk more about this. Thanks for joining us, Anna.
Hi, it's a pleasure to be here.
So you guys at FSG have been interacting with senior decision makers of Western multinationals responsible for the Middle East and African region. Can you tell us what they say are the biggest challenges executives are currently facing in the region?
Of course. Well, as you know, we have been facing a low growth environment now really since 2014, both in the Middle East and Africa. And I think it's probably in human nature to think that things are going to get better. However, the reality is that global growth is remaining a little bit depressed. And especially in the Middle East and Africa region, we're seeing growth rates moving forward well below their historic levels. So this means that businesses really have to wake up to this reality and have to adjust their strategies much more aggressively. Because historically what we have seen is that companies have been setting targets that are far too high, and those are not going to be delivering anymore because realities are just looking quite different today and for the next several years than they were over the last several years.
Now, how's the current economic environment affecting their businesses?
So a lot of them have taken a hit in terms of profitability. A lot of them are facing increasing uncertainty because there are a lot of regulatory changes across the Middle East and Africa regions at present, which are increasing business costs. Especially this is because governments are shifting towards taking a more protectionist approach across the board. So we're seeing in many markets like Egypt, like Nigeria, like Saudi Arabia, like the GCC, we're seeing rising tariffs. We're seeing the introduction of new taxes. We're seeing localization pressures that are forcing companies to invest more locally in countries, which is, of course, affecting the operating costs. And they didn't used to have to do this. So, of course, they're actually spending more at the moment to access those markets. And they didn't necessarily account for that. So now it's about adjusting to these regulatory changes and understanding that the economic environment is causing customers to be quite a bit under pressure, right? Consumers, other businesses, etc. So now these companies need to make sure that they better sell to those companies in an efficient way.
Now, having identified some of the challenges that you mentioned there, do you think they're adjusting their strategies well enough to face the new normal in the region?
Of course, some companies are doing that, and they have taken this into consideration. So we have seen over several discussions with our clients, a lot of companies focusing on product innovations at this point in time. So companies are trying to compensate for lower profitability by bringing new products into markets, innovative products into the markets. But this is obviously not going to be enough because, as I mentioned before, we're seeing a low growth environment for several years. So what we realized through our discussion with our clients at present is that a new approach needs to be taken towards customer behavior, full stop. And that will require companies to do two things. First of all, to look for new profitable customer segments, especially in markets like Sub-Saharan Africa that are still performing very well in terms of growth, but also in markets that are already very well served. And most critically, it's about finding a new approach to selling. Both with their distribution partners, but also with their own teams. Selling needs to get more efficient and things need to be sold that are actually needed on the ground.
So briefly, could you tell us, is there anything these executives are thinking of doing differently, and which countries are they focusing on?
Of course, yes. So they're considering very actively right now to up their across the board.
We seem to have lost Anna there. Anna Rosenberg was talking to us about the business, economic development in the Middle East and Africa. Well, moving on to other stories now, Telecom Networks Malawi has announced plans to spend an additional $30 million in improving its 4G broadband service. The country's second largest mobile network operator says it aims to give better 4G coverage in Malawi's 4 main cities. The company says the additional spending follows an initial 9.17 billion kwacha investment which TNM made in 2016 in 4G LTE technology, coverage expansion, fixed and mobile broadband technology, and various other technical improvements. TNM, which is majorly owned by Malawian conglomerate Press Corporation, has more than 3.3 million subscribers, which compares with a national population of about 17 million people. It posted a 52% jump in net profit to 8.2 billion kwacha in 2016. Over now to South Africa, where the second largest federation of trade unions say Fitch Ratings is very concerned that the country's economic and political situation is not improving. This follows a meeting between the Federation Unions of South Africa and the Global Ratings Agency on Tuesday. In April, Fitch cut South Africa's debt to sub-investment, citing the recent cabinet reshuffle when President Zuma fired his third finance minister in 2 years, and which it feared would weaken standards of governance and public finances. Business Incorporated returns in just a moment. Please stay with us.